Welcome everyone to MaverickTrading.com's presentation on directional versus non-directional option trades. Corey Halliday here with you. You can find us at MaverickTrading.com. Click on the subscribe button to watch more videos like this one. Directional versus non-directional option trading is very, very valuable to understand because there's different ways to make money. So we're going to go through those things together and let's dive in and make a little bit more sense of this. So in order to really understand, in fact, let me pull up a drawing tool really quick here for a minute. If you understand directional versus non-directional, here's kind of the concept. We could call it capital gain. Let me see what color we've got here. Capital gain versus cash flow. Now, think about this using an analogy. What's the difference? Well, one is directional, one is non-directional. What do I mean by that? Let's take real estate as an example. Two people could go out and buy a home. Maybe it's, houses that are the exact same, cookie cutter houses right next to each other, but they might have very different goals and game plans. One of them might be buying this home as a house flipper. So they think they're buying this distressed property. They're going to go in, fix it up, be able to sell it for more money and flip it and turn a profit. That would be an example of a capital gain. I'm trying to buy it low and sell it high. I'm trying to do something in my timing or whatever it may be to make money. So we could put on option trades that make money based on direction. If we're really confident the stock's going to go up, I could buy these calls or this call spread or something. If I'm really confident the stock's going to go down, I can profit from that direction, buying a put spread, etc. Cash flow is a little different. Another investor might buy a home, cookie cutter home again, but his game plan is to rent it out. He doesn't really care what it's quoted at in price day to day, right? Because he's focused on the cash flow. So he needs to get a renter in there. And as long as he fills it with a renter, he's happy. Now, if he goes multiple months without a renter, he's got a problem, right? Because he's not bringing in his cash flow. But his motivation is very different. In fact, he might plan to never sell that house. He might plan to pass it on to his kids and grandkids and so forth. And so the goal and the game plan is very different between these two investors. One is trying to profit based on the directional move that they think they can achieve. They're going to buy this house and flip it later at a profit. The other is just trying to bring in some cash flow and not worried and not even focused, not even, checking what its price is doing. That price might go down, might go up, might go sideways, and he doesn't even care. He's focused on the cash flow. So in the options world, it works much the same way. Now, I always explain this, that when you think of directions, most people think there's three directions a stock can go, up, down, or sideways. And I believe there's five directions. It's kind of a boy band, I guess. The five directions, we'll call them. And why do I say there's five directions? Well, we could go sideways. That's a neutral move, sure. We could go up the expected amount, or we could go down the expected amount. Now, what do I mean by expected? You can actually statistically look it up. You can say, what is the standard deviation? What is the 68% probability range for this stock over the next month? We can pull up that data, and I'll show you here in a minute. And it would tell us, hey, this stock has a chance of going up to, $100 per share, or if it doesn't trade well, it could go down to 90. But it's going to be somewhere between 90 and 100, 2/3 of the time, 68% of the time. So this is more of the expected or kind of normal bullish move, upward move. And this is your normal bearish move, right? And then there's something that happens statistically unlikely to happen, but will happen 16% of the time this way and 16% of the time that way, right? You go outside of one standard deviation, and to get outside of that, well, part of the time you're going to go this way. There's 32% left over, so 16% of the time this way, 16% of the time that way. And that's what we would call, a very, very bullish move. Much more than the market was pricing in and expecting, and this would be your very bearish move. Unexpected that it would fall this far, but it will happen sometimes. Statistically speaking, it'll happen about 1.6 times out of 10 or 16 times out of 100 and so forth. But this is your expected range, and these are your unexpected moves. Now, all of those things happen in the market. So as a trader, we can try to pick direction. And what would we want to do? Well, we'd want to match up our trade with our expectation. So if we think this is a normal environment, volatility is going to be pretty normal to history, we should gravitate this way. And this is a good price target for your trade because statistically, that's where it should go if it's making a bullish move. It really shouldn't go up here. And if it's bullish, of course, it's not going down here. So if you're picking your direction, you try to line it up. There's other times where you say, you know what? I'm analyzing this, and this thing is really going to take off. I think the market is underestimating the amount of volatility, the amount of upside. This thing is a coiled spring. And so you could build a trade in the options market that targets this move. Now, we would go in with our eyes wide open that that's not high probability, but it would have an excellent payoff if we got it right, because we're not supposed to move that far. We're not supposed to make that move. But if we do, there's a lot of money in that. Or, we're neutral. Well, we can target this side. Or we're bearish, but we expect the volatility and things to be normal, similar to how the market's priced. Or, of course, we could be extremely bearish. The market is underestimating how bad things are. The market, the sector, this stock is just set up and poised to go to the downside. And so understanding where that stock is at and what statistically it's likely to do is valuable information. So with that in mind, let's come over to a new tool called Thinkorswim. And I love using this for analytical purposes. Thinkorswim through TDAmeritrade. We can take any stock and you could put in any symbol you want here. Let's just throw in Nike or something. Okay, Nike's at $115 per share. If I hit the Analyze tab, then you'll see this shaded area and see it gives us a probability of being in this shaded area of 68%. But, that's between when and where, right? So we can change the date and it will give us the statistical range probability. See, that's 68% total. In fact, let's put this right here, let's just stack those on this edge and stack these on this edge, and you'll see that shaded area is 68%. So it says Nike's right here, but between now and June 8th, it could be anywhere up to about 123 is its best, upside possibility. And down to 106 is about as bad as it's going to get. Statistically, that's where it's likely to be. So if I'm looking at this and I'm considering the 5 directions, obviously I'm going to go to the chart. I'm going to create an expectation. Okay, I think Nike's bullish or bearish. But I want to use this probability to my advantage. I want to say, okay, I think it's going to be a normal environment, but I think Nike has upside. I should really be targeting one of these numbers. If I think it's an abnormal scenario and Nike's going to skyrocket, well, then I could get out here to the low probability, but get out here and know that I'm doing that. Go in with my eyes wide open, that I'm outside of the expected range, but I think there's justification for that. If I'm bearish on Nike between now and that date, okay, I should probably be targeting one of these moves down here. Only if I'm wildly bearish and think the market is underestimating things would I target something down there. The further you go out in time, the wider this is going to go, of course, because the more time you give this stock, the more wildly it's likely to move, right? So if we go all the way out to, let's go to mid-July or something, now I need to drag this in so we can kind of see the stock prices. Again, I can pull these out. And in fact, you can even just come here and set your slices we could set them to the 1 standard deviation. This has it right dead in the middle. And then this and that, if you add these two numbers up, that's your 68% probability range. So if you want to just click here, set your slices to 1 standard deviation, great. I was moving them. I'm just showing you a few different techniques, but here we go. Nike between now and July, so a couple of months from now, where's it likely to be? Somewhere on a normal bullish move, it's going to get up to here. On a normal bearish move, it's going to get down to here, right? So it helps us. It's very effective in showing us the probability range, and now we can build a better strategy that's backed by statistics. If I'm bullish, and I think Nike's share price is going to go up, I really should be targeting one of these prices up here. Now I'm going to look at the chart. I'm going to analyze that, but I probably don't want to target, a move to 140, and I don't want to target anything down here if I'm bullish, right? I'm going to be targeting something right in this area. Statistically, that's likely to be where we go on a bullish move. Now, that's for directional trading. We want to be within that range. Well, what about non-directional? So let me bring this down, and let's just go to mid-June. Okay, here's where we're going to be likely going to be inside this price range between now and the middle of June. What I could do is put on trades that are non-directional. So what does that mean? Well, what that would basically be would be something like this. I could say, okay, Nike's sitting right here at 115 per share. And I'm sort of bullish. I'm kind of, we call it a chicken bull. Yeah, I kind of think it's going to go up, but I'm just not confident that it's going to go up. What I'm more confident about is that it's not going down. I'm really confident it's not going this way, but I just don't know. It might stay here, it might go up a tiny bit. So you can put on option trades that basically say, okay, where is it not going to go? And once you know where it's not going to go, well, now you don't even need to get the direction right. It doesn't need to go up this way. It just needs to not go this way, right? So we could put on credit spreads. You could do a bull put credit spread or something like that. And a lot of times we'll use credit spreads in more of a non-directional fashion. So if the stock's at 115 and I think, well, it's going to be on this side. This is where it's going to be, somewhere over here. I'm not sure it has a lot of upside. It's just not going to go down. Okay, we might sell the 117 put and buy the 112 put for protection, and that would pay us a credit. And our break even would probably be at 15 or even a little lower than that. And what does that mean? Well, basically, as long as it's on this side of our break even, we're going to make some money. Now, if it goes the wrong way, well, that's the risk we have. This would be a limited risk trade, but we're non-directional. If this thing just chops around and finishes sideways, we're going to make some money off of it. So let me show you kind of the risk graph overlaid on top of that. Let's go to mid-June. There's June 17th. And let's just build that exact trade I just referenced. I was just throwing out some numbers, but if we sell, let's take it down to just a simple one contract. Sell the 117, buy the 112. That's going to pay us over $2 credit. And if I analyze, see that it still has the probability range between now and June expiration. But look, here's your break even, and it's below current share price. So see how that break even is right here. And anything above this price, anything above there, we're going to make some money. Now, if it goes this way, we're going to lose some money. But that's what we were confident about, is that it's not going this way. We don't know how high it'll go, and it might just stay sideways. We've eliminated two of the directions from where we think it can go. We've said it won't go down a normal amount and it won't go down a large amount. It might stay neutral, it might go up a little, might go up a lot, but any of those three and we'll make some money. So that is a non-directional trade, and this would be kind of like the cash flow. Kind of like the guy that just wants a renter in there. He's kind of saying, I don't even so much care where the price goes as long as I can get a renter in there. It's kind of, you know, I don't know that that's a perfect analogy, but it's kind of like I don't even care where the price goes up here. It can go up none, it can go up a little, it can go up a lot. It just doesn't really matter. I just need it to not do this. I just need to not be left without a renter, right? So by eliminating directions that it could go, we can put on trades. And a lot of times with non-directional trades, let me show you another example that we teach at Maverick. What if we did some sort of butterfly or iron condor or something? Let's have fun with this. So let's go do an iron condor. Okay, I'm going to build an iron condor. Again, let's just take it down to a simple one contract. This is the call side. So let's sell one that's way above and buy some protection. And I'll show you this is just eliminating directional moves. And we'll sell one way below and buy some protection or whatever. And let's just see what this looks like. So we'll analyze. Now notice what I've done here in terms of this iron condor is I've said, okay, what have we eliminated? We've eliminated the big upside move. We don't think that happens. And we've eliminated the big downside move. We don't think that happens. But if we get a neutral move, that's good. If we get kind of a normal bearish move, that should be good. And if we get kind of a normal bullish move, that should be good. So an iron condor can target, hey, I think we'll stay within this range. You can see that your break even over here and your break even over here are pretty close to that outer shaded area. So if you look at your statistical likelihood of making some money in this trade, we have a high probability. In fact, I could grab these and stack them right here on the break evens. That will tell me we have a 65%, or I could even set them to break even and it'll do it for me, 65%. But you can see we have a 65% probability of finishing in this range. That means, well, the flip side of that is we have a 35% chance of loss. But if we've done our work, done our analysis, this is a non-directional trade because we don't really care where it goes as long as it's inside of the expected range. So non-directional versus directional trading, but thinking about where it fits in the context of where that stock is likely to be at expiration. Thinking about the probability expectations and building your trades accordingly makes a ton of sense. Hope you've enjoyed this video on directional versus non-directional option trading. Have a great weekend, and we will see you all next time. Goodbye, everyone.